Silver manipulated again. CME kills the market. 24 hours before first notice day on February 25th, 2026. The world's largest derivatives exchange went dark. Silver was approaching $90 an ounce. And then, silence. No trades, no prices, no explanation. Just 2 words from the CME, technical issues. But here's what they didn't tell you. This is the second time this has happened. Both times. Within days of first notice day, both times. At the exact moment silver was breaking out, the vaults are draining, the delivery numbers are historic, and someone very powerful does not want you watching this. Welcome to AO and AG. Now, before we go any further, think of this channel like that one wise old friend who always told you the truth, even when nobody else would. If you haven't subscribed yet, do it the same way you'd take advice from someone who's been around long enough to know better, quietly, without hesitation, and before it's too late. Hit that subscribe button and turn the notifications on. Because when this story moves, it moves fast, and we'd hate for you to miss the next chapter. Now, drop a comment below and tell us, where in the world are you watching this from? Whether you're in London, Lahore, Lagos, or Los Angeles, we want to know who's paying attention. Because what happens in the next 30 days affects all of us. Let's begin. On the morning of February 25th, 2026, something very unusual happened. The world's largest derivatives exchange went completely silent at exactly 12:11 p.m. Central Time. The CME Group, the organization that controls the pricing of silver, gold, copper, and natural gas for the entire world, quietly acknowledged that something was wrong with its trading platform. 4 minutes later, at 12:15 p.m., it was over. The metals market was dead, no prices, no trades, no movement. Gold went dark, copper went dark, natural gas went dark. And silver, which had been climbing steadily toward the psychologically critical level of $90 per ounce, simply stopped. Natural gas came back online within 35 minutes, but the metals market stayed dark for 90 minutes. 90 minutes, during which no trader in the world could buy silver. No miner could hedge their production, no dealer could price their inventory, no institution could protect their position. The entire silver pricing mechanism of the Western world was a black screen. When trading finally resumed, something else became clear. Silver had lost a portion of its gains, and every single all-day order and good-till-date order that traders had carefully placed before the halt had been completely wiped. Gone. As if they never existed. The CME's official explanation for all of this was 2 words. Technical issues. No press release, no detailed investigation, no third-party audit announced, no timeline of what went wrong or how it would be prevented. Just 2 words in silence. Bloomberg confirmed the halt was real. Reuters confirmed it. Multiple financial outlets confirmed it. But what actually happened inside those 90 minutes remained a complete black box. Nobody outside the CME truly knows. Now here's where a serious business mind must pause and ask one important question. If a system fails once it is called an accident, if it fails twice in identical circumstances, at identical moments, what is it called then? Because February 25th, 2026 was not the first time this happened, it was the second. And the circumstances surrounding both failures are not just similar, they are almost identical. 3 months before February 25th, 2026, the exact same story played out. It was November 27th and 28th of 2025, and the CME Group suffered something far worse than a 90-minute silence. The exchange went completely dark for 10 full hours. 10 hours during which the entire metals market simply did not exist. No silver, no gold, no copper, no pricing, no discovery, no protection. For anyone holding a position in the most important commodity markets on Earth. The first explanation offered by the CME was a cooling system failure at their primary data center in Aurora, Illinois. A cooling problem. They said a technical inconvenience. The kind of thing that happens to any large organization running complex infrastructure. Nothing to see here. Move along. But then something quietly changed. Without announcement, without fanfare, without a single press conference, the CME revised their explanation. The cooling system failure became something else entirely. It became human error. The story shifted, and nobody in the mainstream financial press seemed particularly interested in asking why. Now, a serious analyst does not need to be a conspiracy theorist to find that revision deeply uncomfortable. Because here is what the record actually shows. The November outage fell on first notice day for the December silver contract. The February outage fell 2 days before first notice day for the March silver contract. 2 outages 3 months apart. both hitting at the single most sensitive moment in any futures contract cycle, the moment when holders of long contracts can officially demand real physical silver to be delivered to them. When trading finally resumed after the November shutdown, silver did not collapse. It surged more than 5% in a single session. The market that was supposedly experiencing technical difficulties came back with extraordinary force. Institutional voices noticed immediately. Nikki Shields of MKS PAMP, one of the most respected names in global precious metals, told Bloomberg directly that the halt destroys confidence in liquidity and price discovery at a time when the market was already under severe strain. Josh Fair, the CEO of Scottsdale Mint, was even more direct. He said the last time this happened, silver went on a multi-month run, and now it has happened again. A cooling malfunction, then human error, then silence, then a revised story, and always at the same moment on the calendar. There's a number that the mainstream financial press has almost entirely ignored, and that number is 87 million. That is, how many ounces of registered silver remained inside COMEX approved warehouses as of February 24th, 2026. Registered silver is not just any silver sitting in a warehouse somewhere. It is the specific metal that has been officially designated deliverable against a futures contract. It has been weighed, it has been assayed, it has been tagged and verified and declared ready for delivery. It is the physical foundation upon which the entire paper silver market is supposed to rest. And as of this moment, that foundation has never been thinner in recorded history. To understand how extraordinary this is, one must travel back just 6 years. In 2020, registered silver inside COMEX warehouses stood at approximately 346 million ounces. That was already not a comfortable number, given the size of the paper market sitting above it. But 346 million ounces at least represented something substantial, something that gave the system a degree of credibility. Today, that number is 87 million. In 6 years, the registered silver inventory that backs the world's primary silver futures market has declined by 75%. Not 10%, not 25%, 75%. 3/4 of the physical foundation of Western silver pricing has quietly walked out the door, and it did not walk slowly. From October 2025 to February 2026 alone, the total COMEX silver inventory registered and eligible combined fell 31%, from approximately 532 million ounces down to roughly 366 million ounces. In early February, the drainage rate was running at approximately 85,000 ounces per day. Every single day, nearly 8,000 ounces of silver was leaving COMEX warehouses. Now, place that reality against what sits above it. March 2026. Open interest. The number of outstanding futures contracts representing theoretical claims on silver stood somewhere between 240 million and 500 million ounces, depending on the measurement point, against 87 million registered ounces. The ratio of paper claims to physical metal available for delivery sits anywhere between 3-to-1 and nearly 6-to-1. Heavy Metal Stats, which sources its data directly from CME, classified the silver market condition with a single word: stress, not caution, not watch, not elevated stress. When a vault drains at this speed while paper claims multiply above it, only one question remains: how long before those two lines cross in a way that cannot be quietly managed? There's a behavior in financial markets that analysts call a run. Most people associate that word with banks. They picture long lines of worried depositors demanding their cash back all at once. But runs do not only happen at banks. They happen wherever paper promises and physical reality are separated by too great a distance. And what the COMEX delivery data from the last 3 months describes is not a theoretical risk. It describes a run that is already in motion. Begin with December 2025. In that single delivery month, 6 million ounces of physical silver were formally demanded for delivery through COMEX futures contracts that represented approximately 50% of the entire registered inventory at the time. Delivered in a single month. Half the vault emptied and then refilled in real time just to keep pace with demand. The system held, but only barely, and only because eligible silver was being converted to registered status fast enough to cover what was leaving. Then, January 2026 arrived and the data became something else entirely. 4 million ounces demanded for physical delivery in a single month. That number alone would be remarkable, but the context surrounding it makes it historic. January 2026, deliveries represented a 727 times increase over January 2024. Not 7 times, not 70 times, 727 times more silver demanded for physical delivery than just 2 years earlier. That is not a trend accelerating. That is a system experiencing something it was never designed to absorb. February 2026 continued the story. Through February 24th, approximately 24.8 million ounces had already been delivered with a reported delivery rate of 98%. In normal functioning futures markets, the vast majority of contracts are rolled forward or settled in cash. Physical delivery is the exception, not the rule. A 98% delivery rate does not describe a normal market. It describes a market where the holders of long contracts have made a deliberate collective decision. They do not want paper settlement, they want the metal. Then came February 24th. Itself, a single trading day, 229. New delivery notices were formally issued. Wells Fargo issued 228 of them alone. BNP Paribas stopped 155. More than 1 million ounces demanded for delivery in a single day, 3 days before first notice day. When a single bank issues 228 delivery notices on one afternoon, it is not making a clerical decision. It is sending a message, and the message is precise. The paper is no longer enough. There's an old principle in economics that says one commodity cannot have two fundamentally different prices in two different markets for very long. Eventually, the gap closes. Either the lower price rises to meet the higher one, or the higher price falls back toward the lower one. But what is happening right now between COMEX in New York and the Shanghai Futures Exchange in China is not a small gap. Closing slowly, it is a canyon that is widening by the day. And what sits at the bottom of that canyon is the most important question in the silver market today. As of February 26, 2026, COMEX silver was trading at approximately $88 to $90 per ounce. Shanghai silver was trading at approximately $100 per ounce. That is a premium of $10 to $12 on every single ounce, a gap of roughly 12 to 16%, before China's 13% VAT is even factored into the calculation. But that gap did not begin on February 26th. Travel back to January 30th, 2026, the day silver crashed 33% on COMEX in a single session. On that same day as Western paper prices collapsed, the Shanghai premium over COMEX briefly reached $20.98, a 29% premium, and wholesale physical premiums inside China briefly touched 45.8% above the already elevated Shanghai price. Two markets, one metal, two entirely different realities existing simultaneously on the same planet. The reason for this divergence is not accidental, and it is not temporary. On January 1st, 2026, China formally designated silver as a strategic national resource. That designation came with export license restrictions that effectively constrain approximately 70% of global refined silver supply flows. China did not make that decision quietly or without preparation. It made it after years of accumulating industrial consumption patterns that the rest of the world consistently underestimated. Solar panel silver paste alone accounts for roughly 30% of all silver industrial consumption globally. Add artificial intelligence-driven semiconductor demand, and China's internal silver appetite becomes something that no export restriction can easily satisfy from outside its borders. What Shanghai is therefore communicating through its premium is not speculation. It is not retail enthusiasm or market noise. It is the revealed preference of an entire nation-state that has decided physical silver has a different value than what the Western paper market is currently willing to admit. When the East and the West begin pricing the same strategic metal at fundamentally different levels, one of them is wrong, and the delivery data suggests it is not Shanghai. There's an old principle in economics that says one commodity cannot have two fundamentally different prices in two different markets for very long. Eventually, the gap closes. Either the lower price rises to meet the higher one, or the higher price falls back toward the lower one. But what is happening right now between COMEX in New York and the Shanghai Futures Exchange in China is not a small gap. Closing slowly, it is a canyon that is widening by the day. And what sits at the bottom of that canyon is the most important question in the silver market today. As of February 26, 2026, COMEX silver was trading at approximately $88 to $90 per ounce. Shanghai silver was trading at approximately $100 per ounce. That is a premium of $10 to $12 on every single ounce, a gap of roughly 12 to 16%, before China's 13% VAT is even factored into the calculation. But that gap did not begin on February 26th. Travel back to January 30th, 2026, the day silver crashed 33% on COMEX in a single session. On that same day as Western paper prices collapsed, the Shanghai premium over COMEX briefly reached $20.98, a 29% premium, and wholesale physical premiums inside China briefly touched 45.8% above the already elevated Shanghai price. Two markets, one metal, two entirely different realities, existing simultaneously on the same planet. The reason for this divergence is not accidental, and it is not temporary. On January 1st, 2026, China formally designated silver as a strategic national resource. That designation came with export license restrictions that effectively constrain approximately 70% of global refined silver supply flows. China did not make that decision quietly or without preparation. It made it after years of accumulating industrial consumption patterns that the rest of the world consistently underestimated. Solar panel silver paste alone accounts for roughly 30% of all silver industrial consumption globally. Add artificial intelligence-driven semiconductor demand, and China's internal silver appetite becomes something that no export restriction can easily satisfy from outside its borders. What Shanghai is therefore communicating through its premium is not speculation. It is not retail enthusiasm or market noise. It is the revealed preference of an entire nation-state that has decided physical silver has a different value than what the Western paper market is currently willing to admit. When the East and the West begin pricing the same strategic metal at fundamentally different levels, one of them is wrong, and the delivery data suggests it is not Shanghai. Strip away every argument about manipulation. Remove every discussion about CME outages and suspicious timing. Set aside the Shanghai premium and the institutional repositioning and the delivery surge. Forget for a moment everything that has been discussed in the previous 6 parts of this analysis, and simply look at the raw mathematics of silver supply and silver demand. Because even in a world where every other concern raised in this video did not exist, the numbers alone tell a story that serious decision makers cannot afford to ignore. Global silver mining production runs at approximately 820 to 830 million ounces per year. That is the total output of every silver mine operating on every continent on Earth combined. It sounds like a large number until it is placed against what the world actually consumes. Industrial demand for silver across solar panels, electric vehicles, consumer electronics, medical devices, and semiconductor manufacturing currently runs at approximately 680 to 700 million ounces annually. That single category of demand alone consumes roughly 83% of everything the Earth produces in silver each year. What remains after industrial consumption is divided among investment demand, jewelry fabrication, silverware, and the small reserve that replenishes depleted inventories. The margin is not comfortable. It has not been comfortable for years, and it is getting smaller, not larger. The Silver Institute, whose data is drawn from mining companies, refiners, industrial consumers, and government sources, projected a structural market deficit of approximately 182 million ounces for 2025. That would represent the 5th consecutive year in which global silver demand exceeded global silver supply. 5 years in a row, the world has consumed more silver than it has produced. 5 years in a row, the gap has been filled by drawing down existing above-ground inventories. Those inventories are finite. They do not replenish themselves. And the rate at which they are being consumed is accelerating, not stabilizing. The acceleration has a primary engine, and that engine is solar energy. Silver paste is a critical component in photovoltaic solar panel manufacturing. As the global energy transition accelerates and solar installation targets become more aggressive, the industrial appetite for silver does not politely wait for supply to catch up. It simply consumes what exists. China alone installed more solar capacity in recent years than the rest of the world, combined. And every panel in every installation requires silver that must be mined, refined, and delivered before a single watt of electricity can be generated. This is the foundation beneath everything else. Not speculation, not narrative, not community sentiment, pure arithmetic. The world is consuming silver faster than it can produce it, and has been doing so for 5 consecutive years, while the vaults that once held the buffer have been drained to historic lows. Every part of this analysis has been building toward a single moment. That moment is now March 2026, is not simply another month on the commodities calendar. It is the convergence point of 7 separate pressures that have been building simultaneously across vaults, exchanges delivery systems, supply chains, institutional positioning, and geopolitical strategy. And the question that every serious decision maker must now sit with is precise and uncomfortable. When 7 separate indicators all point in the same direction at the same time, what is the probability that all 7 are wrong? Simultaneously. March 1st. Notice day arrived on February 27th, 2026. Beginning on that date, holders of Long March silver futures. Contracts could formally stand for physical delivery. The registered inventory available to meet those demands sat at approximately 87 million ounces. The open interest, representing potential claims, sat anywhere between 240 million and 500 million ounces above it. The system has 3 available responses to that mathematical reality. It can convert eligible silver to registered status fast enough to meet delivery demands. It can offer quiet cash premiums to long holders, persuading them to accept dollars instead of metal and walk away. Or it can invoke emergency provisions, modifying contract terms, imposing position limits, or forcing cash settlement across the board. Each of those three responses carries consequences that extend far beyond a single delivery month. The cash premium option, which evidence suggests was already deployed in the days leading into February 25th, requires a willing buyer of that premium. Someone must pay long holders to go away. And each time that payment is made, the cost of the next payment rises, because the holders who remain know exactly what the metal beneath them is worth. The emergency provision option is the most consequential of all, because the moment COMEX visibly forces cash settlement on contracts that were supposed to deliver physical metal, the foundational credibility of Western commodity pricing does not bend. It breaks. And a break of that credibility does not stay inside the silver market. It radiates outward into gold, into copper, into every commodity, whose global price is currently determined by a derivatives exchange sitting above a vault that may no longer contain what the paper above it promises. What the next 30 days will reveal is therefore larger than silver. It is a test of whether the architecture of Western commodity pricing, built over decades on the assumption that paper and physical would never truly separate, can survive a moment when that separation becomes undeniable, visible, and institutional, rather than theoretical retail and dismissible. The vaults are at historic lows, the delivery demands are at historic highs, the big money has already moved. The East has already priced its conclusion. And the exchange that is supposed to hold all of this together has gone dark twice in 3 months, at the exact moment the pressure peaked. The next 30 days will not whisper their answer, they will state it clearly, and those who understood the structure before the answer arrived will have positioned themselves accordingly. Those who waited for the mainstream financial press to explain it will have waited too long.